Pralay Mondal joins us this morning. Hi Pralay, good morning. Thanks for joining in. I know my team is extremely excited to hear your view on the outlook of the sector, how the quarter has been. So I'm going to start and take it this head on from picking up answers or responses that you gave us last time around. First up, how has the quarter been? And you did tell us, I believe, in the last quarter that margins are coming to a bottom. Is the bottom here?
Good morning, Samina, and your viewers. I think very relevant question that what we spoke in the last quarter, we have sustained that. I think on a quarter-on-quarter basis, we have really done well. Whether you look at the growth on the deposit side, we have grown by 25%. The asset book has grown by around 20%. The margins have sustained at similar kind of levels as last quarter, and sort of I think it is bottoming out. Of course, the cost of deposits is elevated for the system, so is with us. And from a GNP and NPA credit card perspective, we have been a little bit flat quarter on quarter. Though on the credit cost, we have reduced slightly. So outlook ahead, I think we look ahead. I think from Q1 to Q2, we have done better. On YOY basis, also we are doing okay. Q3, we are planning a lot of executions, and hence we are looking forward to even more exciting quarter in Q3.
Pralay, the cost of funds have also increased by 20 bips Q on Q. What factors have contributed to this increase in credit cost, and how do you plan to manage this? Because if you do believe that margins are bottoming out, it'd be nice to know what and how will you manage the rising cost of funds in an environment where rates are rising?
See, I think what's happening for various reasons. I mean, liquidity was an issue. Now, in the last cycle, what RBI governor and the MPC did was they changed the outlook towards neutral. So from that perspective, I think liquidity will be there in the system for a while. At the same time, one has to juggle around with the LCR, with the CD ratio, with NSFR, CASA ratio, so many other things in a time when there is enough demand of deposits. So from that perspective, I don't think that deposit rates are coming down in a hurry. So from that perspective, banks have to manage it pretty well. So what we are doing is we are managing between CDs, deposits, CASA, and borrowings, and of course refinance, which comes at a slightly lesser cost. And overall, while there has been a marginal increase on the cost of deposits, yields have also slightly increased. So to that extent, we have been able to manage our NIM almost at the similar level as last quarter. Going ahead, I think increase in deposit costs will be marginal because the last lingering part of the repricing on the deposits is going on, which should be over in another quarter or so. So I don't see too much of pressure on NIM anymore, maybe another 3, 4, 5 basis points here and there. But beyond that, I don't see any more pressure on the NIM for us.
So, there's been a standout with your earnings, right? There's no concerns so far, at least on your asset quality, but we are seeing across the industry, it's not as simple or straightforward. Your gross NPAs have remained steady. Net NPA also has seen a marginal increase. Any sort of thoughts on what is going on? Do you think you will continue to maintain an improvement on asset quality going ahead? Or do you feel like a couple of quarters out, or even in the second half of this year, asset quality does become a concern for the sector and for you as well?
I think sector is going through a little bit of a, revaluation on the entire asset quality, primarily because of on the retail side, microfinance, on the unsecured side, there is a little bit of a pressure which is building on. For us, GNPA has remained the same, and NPA is hardly 1 basis points up. But the good part is slippages has come down significantly from last quarter, and I think we continue to do that. Credit cost has also come down reasonably well from last quarter. So I think we are sort of picking out on the NPA as well. I don't see too much of an elevation of NPA from here onwards for us at this point of time. And credit cost, I mean, when we are around 15 basis points, it's difficult to say 2 basis points up or 2 basis points down, but I don't see us going beyond 20 basis points for the full year. So to that extent, I think we are pretty clear that credit cost is not a concern for us at this point of time. But yes, for the system, especially players on the microfinance side, on the unsecured side, retail is also seeing some kind of a leverage. Fortunately for us, we sort of slowed down on certain segments like microfinance, personal loans, unsecured side quite a bit. So to that extent, that part of the portfolio is picking out in terms of stress. But one-off cases here and there can happen, so we cannot exactly predict what is going to happen. But I think we are reasonably okay on the credit card side.
Yes, taking a little bit of a step back from lending or increasing lending in the microfinance space has helped. And we've also seen that that part of the economy may be going through a little bit of a struggle going ahead as well. Pralay, how have you utilized your contingent provisions? Have you to begin with? And if yes, do you have comfortable buffer, at least for the near to medium term?
Samina, what we did is during the COVID times, we created a provision of around 105 crores. So we have not touched it. We have converted into contingency provision and we have retained that. Also, above regulatory guidelines, we have created extra provisions. So overall, we have around 183 crores of additional provision, which is a fairly good buffer. And this will continue to grow because our policies are slightly more conservative than what the regulatory prescriptions are. So to that extent, we are pretty comfortable and we don't aim to touch this contingency provision which you have created as a buffer, because who knows, in a cyclicality we need to be a little more conservative, and we believe in conservative mindset. Also, what we did is in the credit cost, we added, unlike last year, we added the standard provisions into the credit cost. So it is not a like-to-like comparison. It is a little more conservative this year, in spite of the fact we have on a quarter-on-quarter basis, we have reduced our credit cost. So overall, we are looking at more conservative accounting going ahead, because that's, I think, the prudent banking in a cycle where one is not sure what's happening in some of the sectors. So we are pretty comfortable on that front.
Just one quick question on the gold loan space, because that's been doing well for you, but we know that the RBI has been sending out feelers and warnings about the processes meeting standards. In your case, any worries there? Are you concerned? Are you going back and sort of fixing the processes that you currently have, or are you confident you'll meet those standard requirements? And of course, the growth will continue in that space.
Yeah, I think growth is happening because of two reasons. One is, for us also, the growth on the tonnage side, which is the real metal, has grown by around 10%, while the growth on the book is around 28-30%. The difference, of course, is because of the gold prices internationally is pretty high, and that is also leading to the high price in India. I don't see, because of the Fed easing cycle and things like that, I don't see too much of a risk on the gold price right now. Having said that, being a conservative banker, we would like to always have a sensitive analysis on what happens if kind of a scenario on gold prices. And we are pretty comfortable because LTV is pretty close to 70%, near around that. So we are pretty comfortable on that front. On those 4-5 points which RBI, the circular on 30th September, fortunately, because we have a large portfolio on gold, we have been proactive on all of this. So almost point by point, when the circular came out, we reviewed and saw that we have sort of meet most of the boxes, actually all the boxes. Having said that, it's being a very touch and feel kind of business. For example, we never did anything other than physical touch and feel kind of a business. We never had those fintech partnerships on the gold loan side and those kind of. We never believed that that's the right model for us. So to that extent, we are pretty much comfortable with most of the processes or policies which has been prescribed. Having said that, being a very touch and feel, we are increasing our audit processes. We are increasing our documentation rigors there, because touch and feel, you never know where somebody is doing what. So we need to constantly monitor that very carefully. But on a big picture, we are pretty comfortable with most of the points which has come out, because we had worked up most of them proactively.
You are growing at a very healthy pace, solid growth, and we'd have loved to talk to you longer to understand the key growth levers in the second half of the year. But congratulations and good luck, Pralay. We'll hopefully catch you next quarter.